Well, I have to be honest. We are in the middle of a once in a decade, maybe once in a lifetime opportunity to build real, substantial wealth. You too can set yourself up for more wealth, more money, and significantly improve your life and possibly future generations if you are prepared. And don't worry if you're not prepared. You have time, but it is running out quickly. So I will show you exactly how to take advantage of this opportunity to join the ranks of the wealthy, but you can screw this all up and turn this once in a lifetime event into a huge zero for you. And if you get any value out of this whatsoever, make sure you like the video and subscribe, as YouTube says 35% of you guys that watch me aren't subscribed yet. And out of those that are subscribed, only 17% have full notifications turned on. And yeah, YouTube won't show you my videos if you don't have notifications turned on. That's why you miss them sometimes. And I know it's dumb and YouTube hasn't changed it yet, but we'll keep banging on them to change it. So let's start by defining a recession first, so you know exactly what we are looking at here. And we are all kind of on the same page since, it's 2021 and we need to have 47 different definitions for everything. The most common definition that everyone knows is 2 consecutive quarters of GDP decline. That is the most common and the one that is most likely to be shown in all the charts indicating where we were past recessions and all that good stuff like that. So we'll go with that definition as well to keep it simple, and honestly it doesn't matter in the end to the actual points in this video on how you want to define it. It just doesn't matter, but that's what we're going to go with. So what all can trigger a recession? Well, a lot of things actually. I mean, anything from war to a contraction in the economy from a devastating event, or a global shutdown due to a health pandemic, or even what we have today, inflation. I mean, a lot of inflation like we have today. So that is what we are dealing with here in this current environment, but we do have some markers of all the others as well. We have the Russia-Ukraine situation. We are still dealing with lockdowns and supply chain issues and all the repercussions from a global pandemic. And we have other events like UK's leadership basically losing their minds temporarily. And we also have the Fed here in the US being perpetually late to every party and then overreacting when they get there. Like really, really late and really, really overreacting. And now that we're in a recession, it's actually the exact opposite of what was happening in the 2008-2009 recession and even the pandemic recession. Instead of the Fed asking Congress for bazookas like they were in 2008 and 2009, we have the Fed doing the opposite and cutting off all the taps and rewinding the money printers essentially. Instead of doing everything possible to encourage hiring and growth in businesses, the Fed is actively trying to increase unemployment and slow down business growth to stave off inflation, which is the biggest threat overall to the economy. So what does that stance do to businesses exactly? You will see margins shrink, cost to do business go up, even if inflation goes down because debt is more expensive now because of the rate hikes, and eventually you have to reduce costs, which means cutting your biggest expense, which for most companies is its employees. It's a unique period in time right now, and every recession is different and unique in its own way. But they all follow the same basic pattern and we all have the same human responses. There is more fear and anxiety than what is really going on, and as the dominoes of the downturn start to fall, those all intensify and create feelings that may not be true in reality. When the value of your stocks declines significantly, you feel poorer even if nothing actually changed in your day-to-day life or to your actual financial situation. If your job is still paying you the same and your bills are relatively stable, or even if some of the bills did go up some, but you cut in other places to maintain kind of everything the same, the reality is nothing changed from a cash flow standpoint. But yet people will suddenly feel like they aren't going anywhere in life, and they feel they are actually worse off in life when the reality is their daily life is exactly the same for the most part. And then when your portfolio of stocks is riding high, you feel like kind of king of the world and you splurge, you spend more, you upgrade your lifestyle, and you feel like you are going places in life even though nothing actually changed in your day-to-day life and from a cash flow standpoint. It all stayed the same. The biggest problem with these feelings is they inevitably lead to very poor decision making that are easily justified in your mind, and then they're reinforced by almost everyone else around you, making it somewhat of a self-fulfilling prophecy and a truth when it's actually wrong and not a truth. Contrast that with the wealthy who, when their portfolio's up, they don't take that as a sign they need to act on it and increase their lifestyle. And then when their portfolio declines, they view those as opportunities instead. This is what separates great investors from everyone else in the first place. They understand what an asset actually is, and they understand how you should actually act depending upon whether your portfolio is up or down. So what do you mean exactly, Luke? I mean, I know my house and my stocks are an asset, and if things are getting worse, why shouldn't I feel bad? And then when they're good, why shouldn't I feel great? Well, I'll be honest with you guys. I would say you are fooling yourself because you don't really understand how assets work, or maybe you do, but your actions and your feelings don't reflect that knowledge. Now, I'm not criticizing, I'm not bashing or judging anyone. I'm just saying your actions and feelings don't align with those that truly understand assets. So let me explain a little bit more, and then you can go bash me down in the comments if you still don't agree with me. I understand completely. Assets don't rise in price in a nice straight line. They go up and usually go up too far, and then they correct down and usually overcorrect to the downside too. If you truly understand that, when your portfolio gets too red hot, you would not feel wealthy and be splurging and feel like you're going places. You instead would understand the asset is going to correct down, and you would be preparing for that eventuality. Not selling it, not trying to time the markets or any of the other nonsense that has been the poorest performing way to handle a downturn, but by preparing for those lower prices by shoring up your finances, cutting out your debt, and starting a side hustle or another business to stack cash and have additional cash flow already coming in before that downturn happens to, basically not only weather that storm, but to be able to really take advantage of it. And then when it all corrects down, you shouldn't feel poor or like you were going nowhere. You should instead feel really excited because you know there is an opportunity to make huge money, maybe even generational, once in a lifetime type money on the back end of this if you are prepared and keep the long term in mind. Heck, it's amazing how new members join my group and they readily admit they don't understand why the group is hopping with excitement on red days. And then when the market has a big green day or two, everyone is kind of let down and kind of moping around. It's just kind of dead in there. But then a few weeks later, after they dive the courses and the lessons and all the materials and get in on the live Q&As and participate, they find themselves excited on red and angry on green days just like the rest of us. So what causes that flip exactly? How does that happen? Well, it's a simple mindset shift to understanding that crashes and recessions normally happen once in a decade, and when they do, they are incredible opportunities to build real long-term wealth. I don't care what the media says or YouTube or anyone else. Let's look at the facts. Every US stock market crash has been a golden opportunity to buy great stocks on a super discount. Every single time. Every time the housing market has collapsed, it has been a golden opportunity to buy real estate on a massive discount. Every single time it's happened, it's been a great opportunity. Every single time in every downturn, the same people who follow the media or the news and now YouTube will say, this time it's different. Every single time. And every single time they are wrong. But let's look at some examples, because me just telling you this is just like everyone else that's saying the world is ending, don't buy, run to the hills, load up on canned goods because the Great Depression is here, or whatever the heck else is out there. During the last 3 crashes, you could have bought shares of Apple at $60 during the illness crash, then $3 per share during the financial crisis, then 30 cents per share after the tech bubble burst. And for more context, Apple is around $140 or so per share today. Someone please explain to me how running to the hills during the past 3 recessions and crashes instead of buying great stocks like Apple was the right strategy. By doing the opposite, just a few $1,000s turned into millions. Those are facts, not theories, not charts and graphs that may or may not show anything. Those are facts. It's basically an opportunity of a lifetime that it happened again and again and again. So for me, I view a crash and a recession as a good thing for me as an investor because I can add shares cheaper than I should be able to on great businesses. And I hear you guys now, and you are absolutely right. You are going to be down in the short term because nobody can time the bottom, so you will be down and maybe down big. I missed the bottom during the dot-com bubble by 40%. And then I missed the bottom in the Great Recession by 20%, and 7 figures were still made on just a few $1,000s, despite not even being close to the bottom. So, honestly, you just don't even have to be close to get there. So the fact is, you don't even have to be close to the bottom to have it play out in your favor over the long run. So quit worrying about it and ignore all the market timers out there that are pumping all kinds of crap. All you need to do is simply take these 5 steps we are covering today and apply them. That's it. Then you will not be sitting up at night worried about your money, and instead you will be sitting up at night excited about the opportunity in front of you to make a lot of money. So step number 1 is to shore up your finances ASAP. If you don't have extra cash at the end of the month, you need to make changes to your lifestyle right now. If you aren't working a side hustle, swallow your pride, watch less football or Netflix or the news or whatever, and get started. And if you have to have the latest iPhone, even though it helps my Apple shares, resist it and stick with your old phone. And if you're driving an expensive car, trade it in and get a junker or figure out how to eliminate it altogether. And if you're paying rent or a mortgage and that asset isn't putting income in your pocket every month, learn how to house hack and get that money flowing in. And we have courses on house hacking and mastering your money in my group, but it doesn't matter if you learn it there or elsewhere. Google it, watch YouTube videos, jump on Bigger Pockets. It doesn't matter, just get the information however you can. If you are not wealthy now, but think you can keep everything the same and just watch a few YouTube videos and get rich without changing everything I just mentioned, you won't have the same results as someone who does do all those things. Actions bring results. Desires are wanting it bring nothing without action. And if it's hard, seems impossible, or is incredibly uncomfortable, it's probably exactly what needs to happen. Step number 2 is to figure out which stocks you want to buy and hold long term. And basically just play out the scenario, guys. If the market drops another 30%, what stocks would you want to buy most? Identify those stocks and then start doing your due diligence on each if you haven't done so yet. And don't try to use their YouTube cheat code and just watch a couple of YouTube videos. You need to actually dive the financials, listen to the earnings calls, review the business models, and all the other things that are encompassed in doing due diligence on a stock. So step number 3 is to create a plan and buy points for each of those stocks. All right, now you know what you want to buy. Now you need to figure out your buy points. You cannot time the bottom, so don't even bother with that. Just get that out of your head. But this is where finding a valuation is key, because once you know what fair value is, then you can create those price targets you want to buy at, or you know what fair value is so you can start executing just a simple DCA. It doesn't need to be anything more complex than a simple DCA, guys. You really don't have to get any more fancy than that. Step number 4 is to relax and stay laser focused during this crash. Do not make the mistake of watching the news or social media or anything else, and if you do, don't fall for the fear and the hype and all that other garbage like that. Use your brain and analyze, and absolutely avoid the chat rooms and the comment sections here on YouTube and everywhere else. You have a plan kind of already laid out. It's time to focus on that and let everyone else kind of freak out while you're focused. Which leads me to step number 5, which is simply to execute your plan. You have done the work, you put in the time, and now it's time to start buying. And guess what? Like we've said before, since no one can time the market, you won't guess the bottom unless you get super lucky, so you're going to be down. And honestly, if that bothers you, you are thinking like a short-term trader, and I cannot help you there. You have the wrong mindset, or you're trying to execute the wrong kind of trading, and this is long-term buy and hold investing. That's what I do. I don't do short-term trades. If you're a long-term buy and hold investor, look at it as you got a discount over the valuation you placed on the stock, and if it goes down further, then you are simply getting additional discounts, and who doesn't want an additional discount on something you're trying to buy, right? The stock market seems to be the only place where things go on sale at 50% off and nobody wants to buy it. In the end, crashes are where fortunes are made. The question becomes, will you do what is necessary to make your fortune? So hopefully this was helpful. And if you don't know how to get a price target or how to do a valuation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.